All right. Good morning, everybody. The market seems to be front running the PPI numbers just a little bit. Over the next week, we're going to get more inflation data. And that's what the whole thing is about, right? So we're getting inflation data this morning. We're going to get more on Tuesday. And then on Wednesday, we're going to have the FOMC next week. If it shows a continuation of a reduction in inflation, we're very likely going to see a very aggressive, very explosive move to the upside. It won't be just some PPI, CPI, FOMC move upwards. It's going to be way beyond that. The whole fear and greed and missing out, and everybody that was butthurt from missing the 2020 March rally, all the hedge funds out there that are, looking at end of year benchmarks, trying to justify their existence when they can't even beat, a benchmark S&P. So there's performance chasing and everything else. If it's a continued decrease in inflation numbers, the move is going to be beyond what we would consider normal, right? It starts to get into parabolic, the extremes of fear and greed. There was an article the other day that talked about China ordering its banks to start buying bonds. Something to keep track of. So we do have PPI this morning. There still seems to be a disconnect with the dollar. It's worth keeping your eye on. By 10 a.m., we should be done with any economic activity. Yellen was out speaking. Like I had been warning, keep your eye out. If you happen to catch Yellen speaking somewhere, pay particular attention. There was a post from yesterday where she was out talking. Reuters wrote it up. She was going on about liquidity and discussing how net prices seems to have peaked and they're starting to abate. I don't think she's done yet, though. You may find she might come out with one more. She likes to talk on the weekends too, so kind of keep your eye on that. So by noon today, you should have a clear afternoon for any sort of 0-day activity that you might want to do. You can see we're in a very clean, very clear contango in the VIX futures. Could just look at it as the VIX too, but with the futures, we have the dates connected to it. So we actually get a curve to measure. This is the absolute normalcy of time and price put together, right? The farther out in time, the higher it should be. And the closer in time, the lower it should be. Just keep in mind that FOMC events are volatility killers. So we expect volatility to shape up and get in line, so to speak, as we come closer to an FOMC event. If we didn't know that today was an economic event, if you, for some reason, just turn on the machine in the morning and you come in and you find it this low in volume, you should be concerned. We're not concerned this morning because we understand exactly why the volume is light. But the whole point of these morning briefings is to kind of point out the things that we need to look at and understand what it is that we're looking at. And this is the overnight volume accumulated. All right. So starting at midnight, it just starts counting the volume that comes in. And instead of having each new bar its own bar by itself, it's adding or subtracting the close of that bar from the current amount of volume already counted. There's a benchmark for the ES between, say, 100 and 200. It's a nice normal range. You come in the mornings, it should be somewhere in that range. And when it's not, if it's really high, there's a whole lot of trading going on. And when it's really low, everybody's sitting on the sidelines waiting for something. That's not a concern on a day like this because we know what they're waiting for. But if we didn't know, you would want to be concerned. It's fine. We don't need it this morning. I tend to just turn it off. When we don't need it, since it's just taking up chart space. We have an MDP. We are above the daily pivot, but at the moment, that doesn't matter. The only thing that matters this morning is that we have PPI on deck. This nice little pop to the upside. I gave a nice call out, I don't know, 20 minutes ago. On a lower time frame, we had an inverse head and shoulders with a measured move up, and we got it. Check your contracts. Be particular about which contracts you're looking at. Some brokers have already flipped over, or some data providers. I tend to use Thinkorswim to help me decide when it's time to change my trade of 8 futures. Thinkorswim will automatically change into the new series. You can see that we have 7 days left. On Tastyworks, it's already changed to the H series, to the March series. So you want to pay particular attention to that. It can really get you screwed up otherwise. Some brokers do it automatically, and some you have to tell it. All right, so for this morning, this one's not even going to be the bigger of the 3, right? We have 3 data points coming: CPI, PPI, and FOMC. Today's one of, and it's the least concerning out of the 3. That doesn't mean that we won't get a move, though, right? So just for a moment, swap over to my SPX chart. You can see this orange line is PPI and the size of that candle as opposed to the CPI. It's not always that way. Here we had a larger CPI day than a PPI day. Here, PPI was bigger than CPI considerably. Other way around here, CPI was bigger here. So, you know, the expectation that there's going to be a pretty big move today, that's pretty solid. There's not a lot of expectation of not getting something, but it's by how much, right? So with this one, it's not going to be any of that fancy stuff where bad news is good and good news is bad. That doesn't apply to this kind of data. We're looking for good news saying that inflation is abating, which would be a continuation of abatement. And that's going to give us a pretty solid shot to the upside. But if it does not show in any way that we're reducing inflation and we don't get a new continuous data point, it might get a little ugly today. Now, this big red candle right there was Jackson Hole. It's what I call the mic drop moment. When Powell came out, was supposed to give a 30-minute speech, talked for 8 minutes, and told the market to basically just suck it up because it was going to be higher for longer. And the market gave us that sell-off pretty hard, pretty sharp. Compare that mic drop day to what we've seen in CPI and PPI days. They don't compare, right? So one of the reasons FOMC can be so violent compared to CPI and PPI is because he comes out talking. And what we're going to get today is just a data point. There's no announcement with it. You know, he's not coming out chipping teeth. And since they're in quiet mode, they're not gonna. But keep your eye on that Nick Tamaros guy. I've mentioned him before. If the Fed wants to say anything about the data point that we get today, they're going to leak it through him. You can go to his Twitter. It's at Nick Tamaros, and I'm sure I'm butchering his name, but he'll get over it. So if the data today is out of line and the Fed wants to say anything about it, it's going to come through this guy. And we already have seen Yellen out talking because she's not restricted from saying anything. She's not one of the Fed speakers. So she's not in a quiet period. And she likes to take that time when they can't talk to go out and talk in the media because she doesn't have to compete with anybody for airspace. It makes sense. I get it. We have been range bound and fighting the curve for quite a while now. And even at this point, we are still within the range. And I get it. I hear from people every day that say, can you give me any kind of idea where we're going? I want to take some trades. Nobody's giving call outs. What's going on? Well, we need something before we can start allocating capital. Now, we've got breadth indicators and we've got signals showing a lot of weakness. All the buying flows from late October into November have started to dry up. We're starting to see more and more negative breath, but we're still in the box. We're still in the range. We need to get out of this thing to put on some good solid trades. Any trade for a swing taken before we get out of this is a bit of a coin toss. You know, you're stepping in front of a freight train. Today, if the news is negative, we're very likely going to come out of this box. This big green candle is kind of the benchmark to the downside. It's too far away for a PPI day to think that we would go that far. We could. I mean, I never want to say that price can't do something, but it's nearly a 5% move. And while we have made those kind of moves before, the data today shouldn't cause that much violence. So at 37.80, I would say is a bit of a stretch. I think it's too far away. But let's think about a 3% move. $38.50 is near a 3% move. That'll be the benchmark to the downside. In the ES, because I was on the SPX, a 3% move would put us down to about 38.65 using the December contract. And I'm going to stay on the December contract for these morning briefings until Monday, because on Monday, Thinkorswim will have swapped over to the H series. That'd be the March ES. There has to be some consistency in the world, so I always just use Thinkorswim. When it changes, I change. So 38.65 with a secondary target of 38.50. I'm still going to hold on to that 38.50. Right now we have a market maker move of $33 and an ADR of $71. So some simple math, about a $105 move. Which puts us back at 38.58. Now remember, if we want to see what violence looks like, going that far with these measurements is normal. 38.58, that would be a shrug of the shoulders. So if things do get violent today, we're going to be looking at, take this 105, or at least just round it, $100, divide it in half, and then add it back to this. So it'd be 150 and a little bit of change. Which gets us down to the COG line at 38.11. So we're looking at 38.50 or 38.11. Some reasonably decent benchmarks. Lightly extreme. It's an oxymoron, like jumbo shrimp. So those are the two downside measurements. We do have a monthly level in the middle of those, and we have the weekly expected move down there. I've recently added another indicator on the daily when we're looking at the weekly expected move. The weekly expected move indicator measures a 1 standard deviation. Well, if we wanted to see what a 2 standard deviation looks like, we can, right? It's just math. So there is a 2 standard deviation measurement for this week at 37.94. That's where things start to get a little bit extreme. And we have made 2 standard deviation moves this year, so it's not like it's out of line. Back here, we hit a 2 standard deviation move in February. It's not the only one, it's just the one that stands out. Here in May, we did it again. So, you know, it's certainly something that we can do. I just don't see that PPI today is going to do it. So we have our MDP, our missed daily pivot, riding above the VWAP. We are back above my quarterly level. You can see how that level was a little bit of a magnet. We just got there and kind of hovered around it, worked with it, fought against it. Now we've got an inside day breakout. And we're waiting on our data point. We've talked about the downside. Now let's talk about the upside. And, you know, looking at what's been coming out with the data, it's a little hard to imagine that we're not going to get good data today. It seems almost inevitable. But that's the kind of language that generally catches everybody off sides. All right, $105 move would get us to 40.70. And that looks like it is last week's high, 40.70. That's the normal set if things just move the way they should. If we get a little extreme, push this up to say 150, 41.11 cog line and above would get us through not only all of this trash, we would get through all of that and break out. And it's worth discussing here. Rob from the Strat has this video where he talks about triggering repeated stop zones. It was an interesting video. I can't remember which one it was, but basically the discussion was, if you have a situation like this and you try to think about where are all the stops, and I get it, it's the ES, right? So it's not like we're looking at Apple or something, but if somebody went short, their stops would very likely be somewhere near the open of that day, or maybe even above the high of that day. And so if you get this bullish move to the upside and it triggers all those stops for anybody that's short, well, how do you get out of a short trade? You buy to close. So that adds to the buying and it fuels more buying. And then that triggers into another level of stops. And it just triggers into another one and into another one, and it continues to fuel it. And you end up getting one of these really big days because it just kept triggering more and more and more stops. So we have that kind of potential. And it lines up with our measured move. So it's definitely within the range of what the range of possibilities of what we could do, and we wouldn't even be out of line. All right, so that was 40.75 and 41.11. It really looks like they're front running this data point. I bet there was a spill. Somebody seems to have the information already. All right, so something to think about is liquidity vacuums. So when we get a really big move, it doesn't look like there is a gap, but there really is. There's a gap in liquidity, and price very often will go back and reset or clear that gap. On this really big econ event on this day, we had talked about that. And by the end of the day, it had gone all the way back up and closed that gap. But yet we had talked about it in the pre-market that morning. And that's exactly the kind of move that we could see, right? A really big bar and then spending the rest of the day taking it off. Keep in mind, though, that if it's good news going into a weekend and we're this close to the end of the year, if it's good news, they might not unwind it the way that they unwound this bad move, right? Where it dropped down and it spent all day running back up. So if it's a big breakout, it's very likely to just continue to move and not back away. Ten-day, 30-minute volume profile. We are above the point of control. There's a little bit of resistance around the 4,000 mark. And again, around 40.30. And then again, around 40.70. None of these should be enough to stop this thing. They would just be areas where we would expect some resistance. And not heavy resistance. They match up with pivot points, though. If you consider RTH open, Globex high, previous day's high, low, close, they line up on those really well. There is a significant air volume or air pocket below 39.20, definitely below 3,900. So if we break to the downside today, there's not a lot to slow us down. When we're at the bottom of the box, we expect to go to the top. When we're at the top, we expect to go to the bottom. It usually takes days to make this journey. So it's not something we normally do in a single shot. We do not have any VPOC or anything to carry forward from yesterday. 42.30 is a VPOC, but that seems way beyond what we measured today. And 37.88 is another one to the downside, but again, seems too far away from what we measured today. It's worth pointing out, I'll come back to this for a second. It's worth pointing out that we have no shape here. Normally we're looking for a classic shape, either a capital P, a lowercase b, an actual uppercase B, or a capital D. And we're talking about the shape of this profile. We don't have a classic shape. We have trash. It's just a mess. When the indicator doesn't offer you a signal, which most of the time indicators are not offering you a signal, you want to be able to recognize it, state it, put it into its place so that you realize, hey, there's nothing here. Don't get distracted and try to pull data out of something that's not giving you data. So Netflix up, it's got a nice little bump this morning, 2.5%. ABC, which is one of our swing trade names, taking a gut punch this morning. You can see ABC's been one of those names that's been doing really well this year. We had that key breakout, and now it seems we're going to get a Busby off of it. There's some Walgreen headlines affecting it. Netflix hit 3% this morning. Taiwan Semiconductors also has news. $81.77. So Taiwan Semiconductors has already made it outside of this range. So closed here, it's going to be opening up here unless, it gets a pre-market dump before the open. If it does begin to fade back, we want it to catch support around that 81.4. It'd be the open of that big red bar. So we'd be looking for it to open, come down, catch support, maybe continue that run to the upside. It's got an ADR of 2.5% and a market maker move of more than 0.75%. Oh yeah, it's got the measured move to get outside of all of this range, above $84. There is a gap to close around $89. Yeah, 89.27 is a gap to close. That's reaching a little bit. China's up this morning, FXI 1.6. You can see that the Hong Kong, the Hang Seng, 9.7%. KWEB, nearly 1%. That's the name that we use, the ETF, for like China names. Your China ADRs, JD, BABA, Baidu, PDD, they should all be doing good this morning. Emerging markets really close to my benchmark of being up 0.5%. Gold is up this morning, so we're going to have an expectation of US dollar Japan being down this morning. .75% coming into a quarterly level though, so a little bit of a concern. We continue to see this disconnect with the dollar. I know I keep hearing people reference this. The disconnect might come back, or the disconnect might fade. The dollar might come back into play, but over the last week, we've seen, looking at correlated market states, that the dollar is not providing the same impact that it had been providing. So while I'm not saying don't look at it, right now the VIX is actually a better tell than the dollar. So something to keep in mind. With that fade in US dollar Japan, we can expect to continue to see gold and silver make that move to the upside. And natural gas is up 0.75% this morning. Looks like Apple's around 144, so it's still sitting inside this red candle. What we're looking for with a red to green is that we're going to open somewhere above where we closed. I like to open higher than the previous day's open because it provides a little bit of support if we happen to fade down after the open and we have something to bounce on. So I like it if they can get up in the pre-market higher than the previous day's open. If not, then they open underneath a major pivot point and they have to rally through that and then pull back into it, find a little bit of a support. It's doable. But when we can, we want to see it open on the other side. This is the SPX on an intraday chart. Just want to point out how many moving averages we're playing around with here. We've got the 20-week that we got back above yesterday, the 10-week, the 100 EMA, and the 100 SMA, and then a 20-period daily and a 4-period daily. So we've got a lot. We're just tangled up in a bunch of these things. Over our head for that upside move, we've got the 100-week, the 4-period weekly, 200 daily EMA, 200 daily SMA, and the 50-week. That's a lot of resistance overhead. The 50-week at 40.42. So it's going to be a lot of support once we get through all of that. But very likely going to be a pretty difficult play. Same thing with Apple. Now these are spread out better, which I don't know if that makes it better or worse. But for an upside move today, we're going to have to resolve all of these pivot points. And that's a whole lot of pivot points. It's a lot of weight and negativity that we have to fight through. All right, we've been fighting this quarterly level in XLF, 34.9. If we can get through that, I want to focus on the next monthly level, 35.5. Financials have been getting it kind of rough lately, especially a lot of the financial names. You're looking at a 2% measured move today between the ADR and the market maker move on the XLF. This would be a nice little scoop pattern if we get the follow through. And for, like a trade setup, you want to see this reversal candle and then a follow through candle, usually a big one. So yesterday after getting that reversal candle the day before, we just inside day yesterday, which makes sense. You know, we've got all these data points. Everybody was waiting on PPI. But now we're IX10 inside day. And it's a narrow range IX10. So it's pretty tight, which is good. That's what we want, because the tighter it is, the more explosive it's likely to be when we come out of it. The benchmark is still going to be the same. We want to open higher than the close. In a situation like this with a red candle, we want to open higher than the previous day's high if we can, so that it provides the support if we begin to fade back after the open. And then it'll be just like that, the strat talk that we were talking about earlier. Each previous day's high is an area where we could expect, liquidity to be at, some stops. We trigger through those stops. It adds to the fire, keeps pushing it higher to the next level, push through the stops, and it just becomes a chain reaction. We do have the ECB speaking today in the afternoon. It's not a economic event, but the European central bankers, they could throw some shade this afternoon. It's at 3:10, so it's going to be in power hour by that point. Anyways, it's not going to be that bad. Shouldn't be. I don't trade that late in the day. And there are wholesale inventories month over month at 10 a.m. I mean, it's possible. And then there's a survey, but those are nothing compared to the CPI, PPI, and FOMC. Like we usually do on Fridays, we want to look at what is projected for next week and kind of put that in relation to what we have this week. This is a very small box, considering we've got 2 economic events on the agenda for next week. Compared to the size of the box that we have this week. So this indicator doesn't recognize contract changes and anything like that, right? It's kind of blind to that. So I wouldn't trust this one this week. When it comes to the ES, you better just do it by hand for next week. The way that you would do that is today after the close around 4:15, come in and look at next Friday's PM settled expected move, and then add and subtract that from the closing price of, at the end of the day today. We can't use the SPX yet because it doesn't recognize anything until the open. So the indicator won't work right now. But that one will be more accurate than the ES, especially since this indicator was designed to be used with the SPX in the first place. So today, after the market opens, go out to your daily chart and look at the size of this box that we had this week and compare it to the size of the box that they are projecting for next week. Make sure the market makers haven't gotten a little confused or just missed the mark, right? I mean, we've seen it happen before. It's important because it's going to mess with your options if you're going to take a swing into next week, which it's not a bad idea. I'm very likely going to be posting some trade ideas, some YOLO plays, really cheap, out of the money, like really far out of the money, cheap call, cheap put, on the idea that between now and Wednesday, things are very likely going to radically change. I should say between now and next Friday. Monday and Tuesday are very likely going to do nothing. All right. So by the end of the day today, you could be thinking about a Monday, Tuesday iron condor. And on those days, you know, opening one up in the morning on Monday or Tuesday, it's not a bad idea, because we're very likely not going to see a whole lot of movement Monday and Tuesday. You know, for the China ADRs being up, BABA's not looking like it's up all that much. In fact, it's not. We closed at 94.17, and right now we're sitting at 93.70. So KWeb might be up, but the names that we've been watching. All right, so we got Baidu, PDD, Billy. We don't have JD, and we don't have Baba, and those two are more important than the other ones. They're like the benchmark. Which means the other ones might be a nice short. Neo's another one that isn't up this morning, even though KWeb is up. All right, it'll be the same thing today, likely, as it was earlier in the week. We're going to be looking at VIX above 23 to see the S&P below 39. If the VIX gets above 25, we're going to be looking for the S&P to break below 38.5. So a significant level. If we maintain inside the range that we had been talking about for most of the week in the VIX, that'd be between 20 and 25. If we stay inside that range, we're very likely going to see the S&P maintain between 38.5 and 4,100. So I know it's not perfect, right? But it's a good benchmark. During the day, if you're watching, you know, what I'm posting, you'll often see where I'll say, okay, the SPX is starting to move here. We need the VIX to break this level if we're going to see a breakout in the SPX. So it's a whole lot easier to do on the intraday when we've actually got the movement and we've got the parity to put together. It's a little harder to do now, but these levels are close. They're a good starting point. The main thing is if we just sit inside this range chopping, then that's it. You shouldn't have an expectation of a breakout on either side, break up or break down. Got to get the VIX outside of these two key levels. And if you look at the way the dollar has been dropping just lower and lower and lower and lower, and you look at the way the S&P has not been continuing to climb higher and higher and higher, this is that disconnect. So, you know, I know some really smart people are been doing this a lot longer than me, who are continuing to lean heavily on the dollar's movement. But I mean, it's not playing out. So the disconnect is there. At some point, you have to realize that what you've been doing isn't working right now, right? And that you can't just continue to do what you have been doing just because it's what you've been doing. Having said that, there is an expectation that at some point we are going to continue to, or we are going to come back in sync. We're in a transition phase, and at some point within the next 3 months, the dollar is very likely going to be moving with us in tandem, not against us like a teeter-totter, where one side goes up and one side goes down. It's going to completely change and move more in correlation with us. But 3 months is a long time. So, you know, there's going to be days where we sync up, and I don't know, it's still worth watching. Just lean into the VIX more, less into the dollar. News should be out momentarily. Everybody be careful, be safe, have a good weekend. Watch the website when I put up the weekend report. It'll probably be Sunday. We'll have a better idea of what's going on at that point.